that silver and the gold and silver miners, the babies of the mama market gold, are going up far more dramatically over the next handful of months and possibly a year or so due to these events we've been chattering about. They know what's going on. And I think silver, after actually a 2-day break that occurred the last day of January, the first trading day of February this year, where most of the break was over at that point. Amazing drop. You've had multiple rally efforts by silver and gold that don't seem to sustain. And they come back down and they nip out the low again. They don't really go much further, but they nip out the prior low to scare people, go up again, then nip out the prior low. They've done it 3 times, Feb low, then the March low, and then a recent low. The upturn we've seen last week when silver was moving up towards 60, via our momentum technical metrics, argue that this rally is different than those 2 prior ones. This one will sustain, and this one will move that market, gold and silver and the miners, up and out of this ink that has persisted for 6 months. And what's on the other side of that, I'm not going to put targets out anymore. We had long ago mentioned that 300 to 500 would be a fair value for silver based on a lot of factors, not merely our technicals, but think about this for a minute. If you looked at the price of, I wrote them down here, lead, steel, zinc, aluminum, copper, gold, and went back to 1980, they were all pretty strong then. They had a big move. Gold peaked in 1980 at $850, for example. Copper, lead, all these base metals hit a high level. And then they plateaued. Silver remained in a 50-year plateau, while these metals are now trading 4 and 5 times that price level of 1980. How come silver is only 16 cents right now above its 1980 high? Something weird is going on there. Now, there have been arguments that have validity that it's been manipulated, and if so, I'm going to say that won't sustain. Reality ultimately wins. And if you're in the way of reality, you can get killed. Now, if silver were merely to reflect the price gains of copper, lead, zinc, steel, where gold's 4.5 times where it was in 1980, and merely say, oh, I'm going to catch up to you guys. Well, you can do the math. Where would we be? Several $100s. The thing is, though, that gold is not going to stop here. When gold re-engages, silver's going to re-engage too. And when we do an analysis of the relationship between silver and gold, historically, going back decades, what was the price of silver versus the price of gold expressed as a percent? We plot that. And you can see a massive spread chart. We call them spread charts. A base built that was like 10 years wide. We've popped out of it late last year. And the pullback hasn't negated that. Silver in 1980 was 6.5% of the price of an ounce of gold. Right now, silver is like 1.6% of the price of an ounce of gold. Okay? So what if silver were to say, hey, I'm just going to catch up to old valuations? Now, when you go to the gold and silver miners, it knocks your head off because the spread chart that we've shown our subscribers is 12 years wide. In other words, let's take XAU index, which is the Philadelphia Gold and Silver Miners Index. Okay, go back to 1980s. Where was it trading in relation to an ounce of gold? If you divided XAU index into gold, it was either side of 25% of a price of an ounce of gold. It was up to 35 at one time, got down to about 18 one time. But on average, for decades, it was a quarter of the price of an ounce of gold. Okay. It dropped to 4% in the bear market in 2015. And still, it's only above 8%. So it's still vastly undervalued to that which they get out of the ground. And they're making money like crazy. Anybody who examines the various gold and silver miners would be stunned by that which they would be stunned by if it were some other tech company. Okay, so we're arguing that what is coming next is not merely that gold's going to resurrect itself into another dramatic leg, but that silver miners, the gold miners, and silver will vastly outpace it.
Silver's 2026 has been a wild ride. After surging to a historic nominal all-time high near $121 an ounce in late January, a roughly 190% year-over-year gain at the peak, the metal pulled back hard, spending much of the summer parked in the mid-$50 to mid-$60 range. As of mid-August, it's trading near $63 to $65, with the gold-to-silver ratio hovering around 67 to 68, well off the extreme lows seen earlier in the year, but still historically favorable to silver relative to the 80-year norm. Some analysts argue silver remains historically cheap next to industrial metals like copper and zinc, which have already multiplied several times over their 1980 peaks, while silver has continued lagging behind.
To be everywhere, yeah. I go into my local Costco, and on each of the cash registers they have a little sign: you can buy gold today. You can buy it right there on the spot. Go back to the back room, give them the 4,000 something, you get an ounce of gold, and it's Costco. Not some specialty store.
Right.
And the public acknowledgement of that in the West is really not strong right now. The public investment in the miners, in the gold, is trivial compared to past histories. So for some reason they've neglected it, and I think it's because they're focused on the stock market.
Well, they are, yes.
It keeps patting them on the back. And actually, when you measure, go back to 2000, the dot-com high, so 26 years. Where's the S&P? Well, it's gained a certain percent. And if you look at the M2 money chart, money supply, it matched the growth in the money supply. Gold has vastly outpaced the growth in the money supply.
Incredible.
Go back 10 years, you get the same picture. Actually, gold's been beating the stock market, yet nobody acknowledges it. I don't know that. Okay. That's beyond our analysis. Okay. And they'll get a lot of stories like that as to why did this happen, or why is the open interest doing that, or why is the commitment of traders doing this. They're going to come and go. The major factor is the ongoing one. One, we have now a government bond crisis. We know Japan has, and the prime minister over there, elected a year or two ago, said we're going to print to save our bonds. Well, what does that mean? Inflate the money supply, meaning inflate. That's the real inflation. I don't care about CPI. That's merely a reflection. Well, now suddenly it's in our lap. Jamie Dimon has acknowledged this months ago, said we're in a bond crisis. We have to deal with it. Well, the reality is there now, and yet we're still not acknowledging it. And yet bonds are punching through or punching out above yield highs going back 20 years. And debt markets are not in good shape.
No.
Especially, we do an analysis of the financial sector in particular, not just so much the AI and the stuff everybody's looking at. And we look at the bank ETFs, and we look at the XLF, which is a broad financial ETF, and their relative performance. In other words, the valuation of those sectors to the S&P is imploding, declining. We're at multi-decade lows in the financial sector relative to its pricing versus the S&P. And we also look at their technical metrics of their trend factors right now. And they're dancing right now literally on momentum structures, what we call structures, meaning like a floor that you can see on momentum, not on price. Such that when they break those, you could expect a quick 10% vomit. Not necessarily a crash. You cannot afford that type of event. And I guarantee you the Fed is watching that sector. They might be cared about semiconductors or AI, but they care about the banks, and they cannot allow a story to pop up about trouble here or trouble there. And yet we assess those markets as dancing on glass right now, those key sectors. Gold knows this. It's been around 3,000 years. It's not a after the fact market. It's ahead of the fact market.
Gold and silver mining stocks have drawn attention for trading at valuations analysts call historically depressed relative to the metals they actually produce, even amid strong profit margins. The Philadelphia Gold and Silver Miners Index, which averaged roughly a quarter of gold's price for decades, has spent recent years running in the single digits as a percentage of gold's price, a gap some technicians consider unsustainable if metal prices hold. Claims that silver's price has been suppressed relative to other commodities remain contested and unproven, but the broader point that mining equities haven't kept pace with record bullion prices is widely discussed among precious metals analysts.
Commodities in general turned up last October by our metrics into another major bull wave. They're still vastly underpriced compared to where they were in 2008, like the Bloomberg Commodity Index is only half where it was in 2008. So talk about inflation being, oops, we missed one. It's going to make up the difference. It's not merely crude oil. Crude oil was a laggard. In fact, we gave a breakout signal in January based on annual momentum, not price. Oil was 65 then, West Texas Intermediate. Only a month later, then suddenly you had the headline chasers come roaring in because they said, oh, this is going to change the world. Well, oil was going up anyway because it's vastly underpriced in relation to its history, in relation to the price of the S&P, in relation to the price of commodity basket. It's an underpriced commodity. And when you have money flow, it goes somewhere. And sometimes it goes into undervalued assets that have less risk, more potential reward. This war, unfortunately, hyped it because you got headline chasers. Ultimately, that war will end, and things will tend to go back to more normal situation because it's doubtful that state will persist forever, but who knows? We can't predict that. But that is a temporary thing, and gold did not go up on it. That's another of these false wisdoms. Global uncertainty helps gold. It didn't. In fact, you go back and look when the Ukraine-Russia war commenced, late February 2022. Gold peaked in March, had a nice decline, so did most commodities, including oil, during that war. And so war doesn't have the same effect that investors usually think, like, oh, gold should have gone up during that time. Instead, it went down. So now it wouldn't surprise me if in some manner we have, quote, peace, the gold explodes. Anyway, but I treat it as, yes, it's an event. It will have impact. But the real underpinning for oil going higher is simply long-term valuation relative to the ongoing decay in the money units. Oil was 140 10 years ago, and 2022 it was 130, and we're trading now, what, 80?
That's about right. Yeah.
We're screaming that it's off the page. Well, they've used the strategic reserves,
Absolutely.
to try to control it, and that hasn't worked.
No.
So, each market is going to have its own excuse, so to speak. But there's this broader picture that we've been talking about, and that is that when you decay the money units rapidly, now more rapidly than ever because you have a government bond crisis, it must be funded. You can't let it burn down, okay? Then that money goes somewhere. And if there's a perception at some point, due to technicals possibly or whatever, that, oops, stock market's really not the place to be anymore. I'm going to move 10% of my portfolio over to, not bonds. They don't work anymore.
Right.
Oh, gold, that's working. Okay. And you get that kind of flow, and it's the monetary degradation of the thing we use to measure prices. And so if oil was 140 10 years ago, let's say, and it's now 80, it's not just cheaper than 140. It's far cheaper than that when you measure versus the degradation in the money unit over that period of time.
That's interesting.
So
of course. Yeah.
The money supply increases routinely about 90% every decade. Now even more so.
Beyond precious metals, broader commodity indexes remain historically cheap. The Bloomberg Commodity Index sits at roughly half its 28 level even after 2026's gains, and oil, despite Middle East volatility pushing prices higher intermittently throughout the year, remains well below its 28 and 2022 peaks in real terms. Analysts caution against reading too much into short-term geopolitical spikes. Gold notably fell rather than rallied in the weeks following Russia's 2022 invasion of Ukraine, undercutting the popular assumption that war automatically triggers safe haven buying. The thread connecting silver, gold, and broader commodities here, in this view, isn't any single crisis. It's the ongoing erosion of purchasing power built into a monetary system now showing visible strain in Tokyo, Washington, and beyond.